What is going on, everybody? My name is Tyler, and today I want to talk to you about tax-free passive income. The more I've learned about investing and creating passive income lately, the more I realize that taxes really take a huge amount of those earnings. So I've been thinking that if there's any way to make income without having it taxed, it's got to be a huge advantage when it comes to the amount of money you get in your pocket. So in this video, I'm going to explore the one and only investment you can make that will generate tax-free passive income today. And this investment is going to be in the form of municipal bonds. And yes, this will work for everybody, no matter how much or how little you're ready to invest. So don't go anywhere. We're going to dig into municipal bonds to figure out if tax-free passive income is really as good as it sounds. To fully understand why tax-free passive income is so desirable, we have to take a closer look at the true costs of taxes in other areas. This way you can figure out if tax-free passive income is really a good fit for your financial goals and your investment strategies. And there's no way to sugarcoat it. The government is going to tax every dollar you make one way or another. And the two most common ways they do this are with income tax and the capital gains tax. So I'm going to break down both of these taxes and show you where you need to watch out for them. So first, let's talk about income tax. Income tax is most commonly understood as the tax that is taken out of your paycheck based on your income level. Income tax starts as low as 10% for people in the lowest tax bracket, but goes as high as 37% for the highest earners. But for most people with average incomes, we're in the tax bracket for 22 or 24% income tax. But income tax actually applies to several areas in addition to the income from your traditional job. Income tax also applies to any profits you earn from selling stocks, as well as any dividends you earn from holding stocks. When you sell a stock for profit within a year of buying that stock, it's considered a short-term capital gain, and therefore it's taxed as income. When it comes to dividends, you're going to owe income tax on unqualified dividends, such as those received from real estate stocks or REITs. But you're also going to be taxed on qualified dividends in the event that you receive them for a stock that you failed to hold for the dividend holding period. In most cases, the dividend holding period requires you to hold the stock for 60 to 90 days around the date that makes you eligible to receive the dividend. Simply put, you're going to be taxed harder if you buy and sell a stock just to quickly earn a dividend. These reasons are why actively trading stocks is so discouraged by financial experts. Every dollar you make is going to be taxed harder because it's not a long-term investment. But you also have to be careful with dividends because they can push up your taxable income for the year. And when this happens, you might be pushed into a higher tax bracket, meaning you're going to owe more money for the year. And this is why dividend investing might not be the best strategy for everybody. In addition to stocks, dividends, and traditional income, income tax also applies to any interest you earn throughout the year. Since income from bonds is technically interest-driven and not dividends, you're going to owe income tax on the money you make from bond investments. Lastly, and perhaps most shockingly, any interest you earn from your bank account is also going to be fully taxable as income. Personally, I think this is really crazy because most bank accounts at best offer like 1% interest for a savings account. When you factor in income tax and inflation, you might actually be losing money by holding it in a savings account. Overall, income tax is one of the harshest tax rates, which makes some of the investment strategies I just mentioned much less efficient. In most cases, it's better to pursue investment strategies that are taxed at the lower rate of the capital gains tax. The capital gains tax is collected whenever you make a profit from selling an investment that you've held for 1 year or longer. Like income tax, your capital gains tax rate will also be dependent on your income level, but it's a much gentler tax rate. The capital gains tax rate ranges from 0% to 15% to 20%, but most people fall into the 15% category. The assets most commonly affected by the capital gains tax are properties, stocks, and qualified dividends. Taxes on the sale of property is a totally different subject, so I'm not going to cover it in this video. I don't know enough about the subject yet, and on top of that, I know there's a lot of different elements and loopholes to consider when investing in real estate. Plus, it's not something I think the average investor will be dabbling with. With stocks, you're going to owe a capital gains tax anytime you sell it for more than you've purchased it for. To prevent this profit being taxed as income tax, you must hold the stock for at least a year before selling it. Then, the capital gains tax rate will only apply to the profit you've made on that sale. So if you bought a stock for $10 and then 1 year later you sell it for $11, you're only going to owe the capital gains tax on that $1 of profit. When it comes to dividends, the capital gains tax is going to apply to the full value of any qualified dividends you receive. Of course, you must also satisfy the dividend holding period that we touched on earlier. But for many investors, this is a more favorable tax rate than the income tax. It'll make your investment go a little bit further, and every cent counts when you're investing for long-term growth and compound interest. So clearly you have a little bit of an advantage when you can secure the capital gains tax rate on your earnings instead of the income tax rate. But what if you could make an investment that wasn't taxed as income or capital gains? What if, in fact, you can make an investment that was entirely tax-free? Well, for many people, the first solution is investing into a 401k or an IRA, but they're not completely tax-free. If you want to learn more about the tax benefits of IRAs, check out the video I made on real estate investment trusts and Roth IRAs. But if you're looking for a way to invest without being taxed at all, there's only one way to do it, and that is by investing in municipal bonds. Municipal bonds, also called munis or muni bonds, are bonds that are issued by local governments. Muni bonds are essentially loans that you lend to the government so they can fund public work projects like facilities and infrastructure. Unlike traditional corporate bonds whose interest is taxed as income, municipal bonds are exempt from federal taxes and in most cases also from state and local taxes. There are some exceptions, but there are also municipal bonds specifically available for people in states like California and New York so that they too can enjoy the tax-free benefits of this asset. And the great thing about municipal bonds, in addition to them being tax-free, is that since they're backed by the government, they're typically very low risk. And this makes them a great avenue for generating passive income. The only time you're going to have to pay taxes on a municipal bond is if you sell it for a capital gain. But since they're typically very low risk, there's not a whole lot of price swings like you would see in the stock market. But of course, as a bond, municipal bonds are still vulnerable to changes in interest rates, so that's a risk you need to consider before investing in them. So let's talk about how you and I can benefit from this tax-free passive income investment, because ultimately, we have to figure out if the tax advantages of municipal bonds are worth missing out on the higher rates of returns of other assets. And to calculate this, we have to find something called the tax equivalent yield. The tax equivalent yield formula determines how much interest you need to achieve in a given investment to make it superior to another investment option. For this formula, you need to know your estimated rate of return as well as the tax rate of your alternative investment option. I found some tax-free municipal bond funds with a 4% return, so that's the number I'm going to be using for my estimated rate of return. I'm also going to run this formula with both my 22% income tax rate and my 15% capital gains tax rate. As you can see, I would need to make a 5.13 return on an investment taxed as income to make a return superior to that I would get from a tax-free municipal bond. To get a better return with an investment at the capital gains tax rate, I would need to earn at least a 4.7% return. Now I can use all these numbers to look at my various investment options and figure out the best financial decision moving forward. Typically, municipal bonds are going to be a better decision for high income earners, because these are the people that already have the highest tax obligations. As someone with an average income, although tax-free passive income sounds great, I can actually get better returns elsewhere by investing in taxable assets. So to determine if tax-free passive income with municipal bonds is your best option, make sure you run the tax equivalent yield formula and weigh all your options. You also need to consider the unique risks of municipal bonds and the state you live in. I live in Florida with no state income tax, so if you live in a high income tax state, you might not get the same benefits. Also keep in mind there are some municipal bonds that aren't tax-free, so make sure you do your research and you fully understand what you're investing in. Personally, after doing this research, I've decided I'd rather take the tax obligations and the higher returns of the stock market than invest in low tax-free income through municipal bonds. However, I think I'm going to move my emergency fund into municipal bonds in the future, where it can hopefully stay relatively stable, stay ahead of inflation, and generate some tax-free passive income on top of it. To compensate for the risk, I'll probably add an extra 10 or 15% to my emergency fund. And in the end, this comes down to the return rates of municipal bonds being greater than the pathetic return rates of savings accounts. But I'm no expert, so make sure you do your own research and consult a financial professional if necessary. There are certainly other ways to generate passive income, so the option that's best for you will depend on your personal preferences and your financial strategy. That said, I'd love to hear what your strategy is in regards to municipal bonds. Are you jumping right into municipal bonds, or are you going to stick with taxable alternatives? Also, if you've got any arguments for keeping your money in a savings account, I'd love to hear them. But that should do it for me. If you stuck around until now and you're still watching, thank you so much for joining me. And if you'd like to see more topics like this, please make sure you subscribe to the channel. Until then, take care, and I'll see you next week.